G'day everyone, welcome to this weekend general update for the 24th and 25th of August. I've been constructing these weekend updates for a long time now, and I trust that everyone's gaining a lot of benefit from the bigger picture calls and strategies that I've been making. Now these important weekly updates go out to members and also to non-members, and for people that aren't members, the information is a bit in isolation from the real context of what's going on. So people who aren't members of Specialist Share have been missing out a bit on some of the valuable context of exactly what we do within the program. So starting today, I'm going to add a little bit extra to these weekend updates just to give non-members a bit more valuable context, so I hope you like it. Now, I just want to start today by just briefly touching on why I do what I do, because a number of people have asked me about why I continue to to be as active as I do. Why don't I just trade and invest for myself? And of course I do that, but there's a number of other aspects and a number of other key reasons why I run the business in the fashion that we do. The first one is that it really allows me to combine my business activities with something that's become an absolute passion of mine over the last 10 or 15 years, and that's a great place to be. Not that many people get to combine their business activities with their hobby, in effect. It allows me to make a difference, and a difference in two respects. There's an educational component. If I can help people become more market aware and more market savvy, then I can save you an awful lot of financial pain over the years. I remember back, I got taken to the cleaners regularly in my early days, and I think I can make a significant difference to just make you a better investor and more market aware in terms of your financial activities. And the second part, of course, is to help you build wealth, the actual nuts and bolts of making money. And certainly we've had a terrific year this year. In a way, it enforces discipline on my trading and investing, because I've constantly got to be fine-tuning strategy and evaluating the processes that we're using. So I trade and invest exactly as per my recommendations that go out to members. So it really does enforce some discipline on what I do. And finally, and really importantly for me, it allows me to work in business with my son, and anyone that's been in that position would understand the real benefit of being able to do that. So that's why I do what I do. Now, in future weeks, amongst many other things, I'm going to regularly update the results of our trading recommendations. These are public, and they're pre-approved by an independent compliance company. So everything that we do goes through that process. So you'll be able to follow each month the progress that we're making, and I'll start that particular one next week. But we've certainly been getting some really good results through this year. So let's have a look at the overall weekly summary, the global picture. Look, China's in pretty good shape, really, and that's not just my opinion or the opinion of some people. There's an awful lot of people out there that have been calling for China to fall over for 2 years now, but you've just got to look at the indicators, the trade data and all of those sort of things, the construction activity and the retail sales, and just look at the data dispassionately, and China is in reasonably solid shape. And probably just one indicator that I can point to is that through the week just gone, Fortescue Metals posted some great results and increased their dividends. And now, first of all, the results were better than expected, and secondly, unless they're completely silly, which they're not going to be increasing their dividends at a time if they were concerned about what was happening with iron ore imports into China. So I think you can probably park a lot of the negative sentiment about China away and just forget about it, because it's just not the way that it is. Now, America continues to recover. Yeah, it's a bit on the slow side, but they're still recovering, and with the energy revolution that's going on in there, the improving housing market, things are certainly heading in the right direction in America. Now, even Europe is looking better. these days as well, and in Japan, which was another basket case, their policy seems to be working as well. So there's a lot of positive things happening out there. Now, stocks are not expensive at this point in time, and I'm talking global stocks, unless interest rates really spike up. Now, they're starting to head in that direction in America. They've just turned back over in the last few days. Stocks, however, will start to look expensive if interest rates do keep spiking up. So that's one to watch. Now, yes, stock values have gone up a lot over the last couple of years, and they are being helped by all the financial stimulus. But that stimulus is really filling the confidence gap until the recovery picks up steam. Now, I know that there's probably going to be a day of reckoning at some point in the future, but I don't think it's particularly any time soon. Now, let's move on to the specifics. The S&P index is into correction mode, as I've been talking about now for a couple of weeks. Just in the last few days, we've seen a bounce from oversold, which is what you have to expect. It's always going to happen. And the next few days is going to tell us a lot about the depth of the US market correction and how it's actually going to play out. So I've got some nominal targets. Worst case, probably 1465. I don't think that's the way that it's looking at the moment. Or 1570 is probably a more likely area to look at. So let's have a look at the S&P 500. So you can see here is the June correction. We had a three-wave correction to the downside, brought the market back into line, came down to the 38.2% retracement level of this whole run that started in November of last year. So that was pretty normal. We then had a further advance, formed a new high, and we're now into another, I suspect, three-wave correction to the downside. So we've had one wave. I think we're just in the process now of getting the inevitable bounce back. Now, depending on how far up this goes will tell us a lot about how far down the C leg will go. So that's how the pattern, I believe, will play out. If it stops around about where it is now, then expect to see lower prices than would otherwise be the case. If it's got enough strength to get up here closer to 1685, 1690, then expect that C leg to the downside to be more shallow and more mild. So the next 2, 3, 4 days will tell us a lot about the next 2 to 3 weeks. So these are the areas I'm looking at. 1570 is an area that we'd be considering, or possibly down as low as 1465. So that's the S&P. We'll just see how that plays out over the next week. Looking at the Australian index, our market actually, for one of the rare times this year, is looking a bit more resilient. It actually gained 10 points on the week, and money continues to flow into the big resource stocks. They were the main contributors again, as people realise that the global economy is actually doing better than what all the doom and gloom people were saying. And the best small caps also proving to be highly resilient. There really have been some terrific opportunities in that space. So let's just have a quick look at the ASX 200 just for the record. I don't follow it a great deal because I don't think it tells us very much. It's reflecting such a limited number of stocks, but you can see pretty solid week. So I think our index will continue to outperform in the short term because of the recovery in the resource majors. Now moving on to gold, and this is probably the bigger news story, and that's the gold spiked up above 1350 and actually touched 1400 during the week. So that's been a real positive for gold. The real key to me is 1425. If gold can get above 1425, then I think that's pretty much confirming a new bull market. Until there's a close above 1425, the possibility of another leg to the downside still exists. And gold stocks and gold stock indices pushed higher during the week as well. So let's have a look at those. So we'll start first of all with gold on a daily basis. So you can see that the spike up in the price of gold touched 1400 on Friday night. This final price candle is not actually correct. Gold finished at 1396, so it actually finished more positive than that. So putting a retracement structure on this whole run down, this is the high in October of 2012 down to the recent low. The 38.2% retracement comes in at 1422, which is also these previous highs. So if we can close above 1425, then I think we're back in business in terms of the gold heading into probably its most powerful leg of the last decade. However, it does need to clear above that level first. Now let's just look at silver, because silver's really been outperforming gold. And you can see silver had a very strong finish on Friday night, and there's been a big turnaround from $18, and now silver is back at $24. So that's a 33% rise in silver. And that's the way it always happens. Silver will always outperform gold in both directions. Let's have a look at the GDX index. We've been forming higher highs and higher lows over the last few months, and Friday night did nothing to change that. But the bigger mover is in the GDXJ. So this is the junior gold stocks. Now there's a bit of an adjustment in the index, so we've got to ignore that big gap. But you can see just in the last few months that the junior index has actually done a lot better than the main gold index, and that's a very positive sign when the junior gold miners are rebounding as much as they are. Now over the months we've been looking at this division between the gold price and the value of the GDX index. It's looking more and more like this is a base, and we're heading back up again. And as I've been saying all year, you're going to see gold stocks outperform gold. They're going to turn around and go back up before gold does as well. So that's looking quite positive also. Now copper has remained pretty steady around $3.32. Oil's also been pretty strong, holding above $100. This is a copper chart, so you can see it's really it's done pretty well over the last few months, and that's also a good sign of what's going on globally. And just finally, to wrap up, in terms of the overall strategic approach, we're in this US market correction. It could last for another 2 weeks, could last for another 4 to 6 weeks. I tend to favour more the shorter, shallower exercise at this stage. So it's just a matter of being patient for a few weeks. There'll be better buying opportunities. But what happens in the US does depend an awful lot on what the US Fed says about tapering quantitative easing. So that will have a big determinant on the market. Now the very best stocks are still making gains. The small to mid cap stocks that we've been trading and investing in very successfully this year continue to rise, even though we're in a correction phase in America. Some of them had a terrific week last week, so we're still making some great gains there. And over the last few weeks, members have been winding back exposure, which was the right thing to do. So we're really beautifully positioned for the next phase. Should be a pretty good run into Christmas, I would expect. So as always, if anyone would like to find out more about what we do and know how we've been profiting pretty consistently all year, then feel free to contact me. That's my email address there. I'm happy to talk to you via email or by phone, and best wishes for what you're doing for the rest of this year. So that's it for this weekend. Next weekend, as I said, I will cover the progressive results and keep that record going from here on. So that's it for now. Cheers.